SpaceX is preparing what could become one of the largest IPOs in financial history. Shares are set at $135 and will hit the Nasdaq this Friday, June 12th. According to its filing, the company plans to offer roughly 556 million shares, or raising about $75 billion, with underwriters holding an option to purchase an additional 83 million shares, potentially bringing the total raise to more than $86 billion. Elon Musk himself is expected to retain over 82% voting control. Leading the deal are Wall Street heavyweights including Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and JP Morgan. Investors aren't simply buying a rocket company, and that's the important key to understand. SpaceX has evolved over the years into a diversified infrastructure business spanning launch services, satellite communications, national defense, and AI infrastructure. While Falcon launches built the company's reputation, its largest business today is Starlink, the satellite internet network that generated more than $11 billion in revenue last year and occupies its largest segment by revenue. Total company revenue is estimated around $18 to $19 billion last year. The biggest debate on Wall Street now isn't whether or not SpaceX is a good company. It's whether it's worth the price. Critics point out that at a reported valuation near $1.75 trillion, SpaceX would be worth more than the combined market value of major aerospace and industrial giants combined, including Boeing, Airbus, RTX, Lockheed Martin, Northrop Grumman, Honeywell, and GE Aerospace. Supporters, however, argue that Elon Musk has built a category-defining monopoly in launch and satellite communications that will have far-reaching impacts on humanity in the future. So is SpaceX the next great public company or the most ambitious valuation Wall Street has ever attempted to justify to date? That's what we're discussing today, along with the market's current special situations with Jay Singh, founder of Special Situations Report. This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here and use my code LIN, L-I-N. And new users will get $10 when they trade $10. And right now, traders are predicting that there's a 50% chance of SpaceX merging with Tesla before May 2nd, 2027. So if you put $50 down, your payoff could be $87 if you're right. Now on to the interview.
Thank you, David. Appreciate it. Always happy to be on here.
It's happy to have you. Yes.
Same. It's been a very interesting May and June with moves in the market that you likely couldn't have predicted just looking at where the VIX is. But we've had ferocious sector rotations. We have retail investor positioning, the highest it's ever been in equities. We have a IPO boom where we should see $250 billion of equity issuance over the next couple months.
Yeah.
It is a very interesting time to be alive. Let's just say that.
I have not, to my recent memory, experienced a time such as this when IPOs were eating up not just media headlines, but also just chatter in real life. I was at a restaurant yesterday, a Chinese restaurant, and next to me, I overheard a conversation about the SpaceX IPO. Just goes to show that everyone's talking about it, not just people within finance. Let me just start by showing you this comment from Tom Lee. This is from CNBC. Tom Lee's clients are worried about SpaceX IPO being the market top. Apparently, he's not. Tom Lee thinks the concerns that the market doesn't have the liquidity to handle mega IPOs slated for this year, including SpaceX's on Friday, are overblown. He says that he called those concerns misplaced. Now, let me just stop here. The concern here is that IPOs signal a market top, especially when you have such a high concentration of IPOs happening within such a short amount of time, like you stated earlier in the interview. People are raising money, presumably near what they believe is a high for the market. Otherwise, they wouldn't be raising money right now. Does this signal a market top to you, Jay?
Well, thanks again for having me. What I have found in the past is when you have euphoria in the market, that's when companies usually tap the markets for
Yes.
very large IPOs. And so if you look at the last IPO top in the market, it was in 2021, where you had several small IPOs through SPACs, but you also had a number of SaaS companies or software as a service companies, which are now in the doldrums because of AI. But you had a number of those companies IPOing, and basically every single prospectus that you would read would say, hey, we are a regional monopoly or we are an oligopoly. But if you have several hundred SaaS IPOs, it's impossible for them to all be monopolies without encroaching on each other's verticals. So, um, during these phases, market tends to get a little bit nutty, and definitions of fundamental definitions tend to be stretched, right? Um, whether it's you know WeWork and their community adjusted EBITDA, or what we're seeing now with SpaceX, where it's valued effectively at 260 times forward EBITDA, even though that's not a relevant metric because its free cash flow is so negative. Its free cash flow is going to be its negative free cash flow will be a multiple
Hmm.
of its EBITDA. So what I am worried about is that free cash flow is no longer a relevant metric. We've actually seen the Mag 7 tech stocks. We've seen their free cash flows effectively go down to zero, and the market is euphoric because, well, their earnings are up 50%. The only reason their earnings are up 50% is because they are spending so much on capex, and that capex is draining all of their cash flow. Not only that, they're no longer buying back stock. They're issuing debt through SPVs, hundreds of billions of debt through SPVs, and Google just issued 80 billion of equity ahead of the Anthropic, OpenAI, and SpaceX IPOs. So we're going from a period of very conservative, accretive capital allocation in the market, a period where investors valued companies that generated free cash flow, to a point in time where investors are focused on gap earnings, which are artificially high due to understated depreciation, um, and are wed to these forward expectations for AI productivity that have not been proven yet. So, if we go back to the SpaceX IPO, as I don't want to get too far off topic, the
Yeah.
IPO is moving at rocket speed. The official public debut is for Friday, the 12th. The ticker symbol will be SPCX on the NASDAQ, and the final price will be formally set on Thursday, which is June 11th. Okay. One interesting thing about this IPO, which is why so many have been excited about its potential volatility, is that in an unusual move, the Nasdaq loosened its rules to allow SpaceX to actually join the Nasdaq 100 after just 15 days of trading, provided it maintains a top 40 valuation. The S&P has not done this, but what this does mean for Nasdaq index funds will be that people will be forced to buy billions of dollars worth of the stock almost immediately. And actually, the New York pension has actually challenged this. Um, Now, in terms of size and valuation, the share price has been indicated and not confirmed at $135 per share, which was following a 5-for-1 private stock split executed in May. The raise is going to be roughly 555.6 million shares to raise about $75 billion, the biggest IPO of all time. You will see OpenAI is estimated to do another 60 billion IPO, and so is Anthropic. So if cumulatively they should do 200 billion, and then when you add, the equity raise from Google of 80 billion, that's well over a quarter trillion, or 280 billion of equity raised by the end of this coming third quarter.
Yeah.
Now, the valuation is implied by the 135 is about 1.75 to 1.78 trillion, which instantly places SpaceX among the most valuable companies on Earth, trailing only names like Apple, Nvidia, and Microsoft. And another thing that concerns me about this IPO is the unprecedented retail access. So, unlike most IPOs that basically cater to institutional investors, SpaceX is reserving up to 30% of its shares, or 22.5 billion, for everyday retail investors through Fidelity, Robinhood, Schwab, and SoFi. And they've actually reduced the net worth requirements, I think from like 500,000 to maybe even 3,000 at some of these brokers, to to increase the oversubscription. So I think as of today,
Hmm.
banks are saying that the IPO is going to be about twice oversubscribed.
Hmm.
And I'll take a break there to see if you have any questions before I go into, the actual operations of SpaceX.
Yeah, we do. Well, I want to get into that, and I want to talk about IPOs in general as well. Broker stocks rally as FINRA scraps 25K day trading rule that came out a few days ago. Do you think the fact that the regulators scrapped the $25,000 day trading rule, which is the pattern day trading rule, just to clarify for the audience, you have to have at least $25,000 in your brokerage account, otherwise you can't trade more than 5 times a day per the old rule. That's been scrapped as of last week. Do you think that had anything to do with the fact that upcoming IPOs are going to require, as you say, retail interest?
I think that that is certainly a part of it. So let's provide some background here. So the FINRA, FINRA has eliminated, the pattern day trader rule, the PDT rule, which
Hmm.
historically required investors to maintain about 25 grand minimum balance to execute multiple day trades. Now, brokers today only require about 2,000 minimum, because about 4 days ago, this rule was no longer required. So you don't need to maintain 25,000 in your account to do multiple day trades. The standard minimum at most retail brokers is about 2,000 right now. Um, and what I think, is happening is as the markets become more gamified and these IPOs require, retail interest. One way to increase retail interest in day trading and equities, is simply to reduce regulatory requirements. So,
Hmm.
um, you know, it's a very suspicious timing. I can't say for sure, why this happened and when, but it is a very interesting timing that right before a quarter trillion of uh, of new issuance is about to hit the market, all of a sudden the pattern day trader rule has been taken away.
Well, I have here a chart or table showing what happened to prior IPOs, tech IPOs, a week after the stock debuted. Now, let me just show my screen very quickly. I got AI to put this together for me. I remember when I was in school, the Facebook, now called Meta IPO, was all the craze. This was back in 2012 and immediately went down afterward, which made me think, gee, did that happen with every other major tech IPO that we now call it Meg 7? I didn't put some of the older companies in there, like Microsoft, because way too old, not
It's
relevant anymore.
definitely not the case.
Yeah, exactly. So you have here Meta going down 21% the month after it IPO'd. Google went up 55% in 2004. Tesla went up 15 to 20%. Amazon went up 65 to 70%. Netflix went up 15 to 10 to 15%. And by the way, Tesla was pre profitability when it IPO'd as well, similar to SpaceX. Now, SpaceX's valuation gap is even higher relative to its peers. And so the notion that everyone's saying, well, you're just exit liquidity for venture capitalists, history has shown that, like you said, it's not always true. Hasn't always been true that these tech stocks IPO'd and then a market and then they corrected immediately afterward. What's your response? How do you look at this?
Yeah, that's a good point. With a lot of these IPOs, it's very difficult to guess the immediate trading price, right?
Hmm.
But within 6 months of the IPO, not the immediate trading, there is something called an IPO unlock. And so the 6 month IPO lockup is basically contractually mandated, um, where the initial public offering doesn't allow company insiders, which include like executives, founders, early investors like VCs. It restricts them from selling their shares. So usually, as you get closer to that 180-day period, you do see some of the initial euphoria sell off, or in the case of IPOs like Figma, you see, the shares sell actually even below where they were issued. Um, and the primary goal of that 6 month lockup, especially given how small the float is going to be for a case like SpaceX, where it's 75 billion of 1.75 trillion, is effectively to stabilize the stock price to prevent early investors from immediately liquidating their assets and flooding the market with excess shares. So the initial price is always a gamble. Um, But I do think that as you get closer to that 6 month period, you can get some some hedging and selling ahead of that from non pre-IPO holders. And what I do think could be different this time is you do have that Elon premium. So if you look
Hmm.
at Tesla, right? Tesla is the most overvalued company in the Nasdaq and in the Mag 7. So when you think about Tesla's free cash flows have been falling, its margins have been falling, EV sales have been dwindling, and its three other business prospects are many years in the future, but it still trades at this huge premium, right? And that's because funds like Barron, funds have huge conviction on Elon. A number of retail investors have huge conviction on Elon. People made loads of money investing in Tesla early on, and so you may have that premium. And if you actually look at Hyperliquid, which trades perpetuals, I think over the weekend when SpaceX started trading, it was actually over 200. So it was, if you just quickly do the math, it was trading at roughly a 2.6 trillion valuation. I think now it's around 150 to 160. You could effectively use perpetual futures or to effectively hedge your equity as well, which is why I think some of that premium has come down. But if we talk about the actual company, I do think that there's some major risk to holding the IPO long term. Effectively because Elon has supermajority voting rights,
Hmm.
more than any other public company, more than Buffett had with Berkshire, more than Zuckerberg had with Meta. This IPO is really not for the faint-hearted. The company generated about 18.7 billion in revenue according to the prospectus in 2025, but it's deeply loss-making. It lost 5 billion in 2025, and losses accelerated wildly in the first quarter of 26, which is probably why it needs to raise money. It lost 4.28 billion in a single quarter, which means that its run rate for losses is about 17 billion for losses, almost equal to the revenue it had last year. Um, on a sales multiple, we talked about EBITDA multiple. The company's trading at close to 95 to 100 times annual sales, which is richer than any of the big tech peers. And the massive spike in losses, has been driven by Elon's decision to merge his artificial intelligence firm XAI into SpaceX in February. So investors are no longer just buying a rocket company; they're basically funding a massive AI data center play, which is actually doing deals with some of the Mag 7. So SpaceX basically disclosed that it's burning about 2.5 billion a quarter, or roughly half of its burn on just AI infrastructure, including a 220,000 GPU Colossus data center, which I believe is in Tennessee. The upside is huge if it's successful in building this data center and leasing out space. But in the meantime, the company is burning about 20 billion a year. Um, SpaceX is also obligated to use 20 billion to repay a bridge loan that it took in March because of its huge cash burn. So that 75 billion raised is not going to go to rockets or Mars right away. It's going to go into AI. It's going to go into the satellite business. It's going to go into obviously the long-term goals, but 20 billion of it's going to be used to repay a bridge loan, and then the remaining 55 billion is going to meet more immediate needs by the company. So Musk has about 82.4 to 85% of the total voting power here, and he can also dilute the equity and pay himself a lot more depending on which, obviously which hurdles he actually hits. In the case he actually hits the hurdles, the company will be doing well. But there are also some operational hazards, with a company like this, right? Um, you could have launch failures for Starship or systemic issues with the Starlink constellation. You could have regulatory issues with certain countries not wanting to work with SpaceX, especially in Europe, where there's this tech war now between the U.S. and Europe after the tariffs. So it's a hyper complex situation with a lot of built up retail demand. Where one person has all the control, and there are a number of loss-making operations and cash-burning operations. So what you really need to do to understand this company is build the sum of the parts. Starlink is obviously the profitable business. The next business that potentially could be profitable is the AI data center business with Colossus. But then everything else, all the moonshots are going to be burning loads and loads of cash. So it's very difficult for anyone to predict where this could be trading 6 months, 1 year from now, let alone in the first week.
Okay, I want to talk about the IPO and underwriting process. Now, Goldman Sachs, your former employer, is now leading the offering rounds, followed by Morgan Stanley, Bank of America, Citigroup, and JP Morgan. The $135 fixed price at IPO, how is that derived? In other words, if you were on the underwriting desk today, how would you what kind of assumptions would you come up with to derive the $135? Tell us about the underwriting process and ultimately how the valuation for something like this is made.
Okay, absolutely. So, with a company like this, you really have to throw um, fundamental analysis in the water. Usually, there is a valuation done. You usually have a group of underwriters that effectively share in the fees and syndication of the IPO. Um, but here, well, let's just go through, how a basic IPO works. So
Yeah.
an initial public offering is basically where you have a privately held company, where the stock is owned by either early investors like VCs or growth equity firms, or here owners and employees like Elon and his engineers. Um, and what a bank syndicate does is it transitions this company from a private company to a public company that trades on an exchange. And in the process of doing this, it allows investors to sell equity, or for the business to raise new shares in the market, to essentially fund operations, give early investors a payback, as you were saying, bailing out VCs. Um, and then three, to generate liquidity in the underlying shares, so that the company can raise more capital in the future. So there's basically three phases of this IPO. The first phase is what we've been reading about in the news. It's a pre-IPO phase where the company hires investment banks. So here Goldman is the lead, but there are several other investment banks. The only one they left out is actually Jefferies, and I believe Jefferies is actually working with hedge funds to figure out a way to short SpaceX, which is pretty silly. They should have just worked harder to share in the fee. The, the, the fee sharing. But anyway, what the banks do is they evaluate the company's financials, they determine a target value, they help structure the offering, they put together a prospectus. And the prospectus is this regulatory offering where they detail the company's business model, its financial history, its revenues, gross profit, earnings, free cash flows. Um, and then after they put together this SEC approved prospectus, they begin the marketing phase. And in the marketing phase, company executives and underwriters, they go on a roadshow to all the big hedge funds, pension funds, insurance companies, mutual funds, sovereign wealth funds all around the world, and they go with management and they pitch the company. And here, right, they're pitching it as Elon's baby. It has XAI, right? So it's going to be an AI powerhouse. It's going to have this Starlink satellite. They're going to put up thousands of new satellites per year. They're going to bring broadband to all the areas in the world where you don't have uh, high-speed internet access. And then, Elon is going to use his 85% control to actually fund space exploration alongside data centers in space, which don't require cooling. So they've pitched this very optimistic picture to these investors. It's very unclear, how they came up with this valuation. As I said, 100 times sales, 260 times forward EBITDA. There had to be, a lot of hopium built into this prospectus. In fact, if you read this prospectus, there are dozens of pages of just rockets. There isn't actually a lot of fundamental meat to actually do evaluation on. But after the roadshow, based on institutional demand, they get reverse inquiries from these investors, and underwriters establish a price range, and then eventually, like on Thursday, they will lock into a final price the night before the stock debuts in the market. And in
Mm-hmm.
this case, the price is based on prior rounds. It's based on revenue growth and a sum of the parts and pitching. It's not actually based on cash flow. And then after you do the marketing phase, you have this third phase called the market debut. And on the market debut, which is the trading day on Friday the 12th, the newly created shares, about 75 billion of the 1.75 billion will be available to trade, on the Nasdaq, for example. And so here, everyday investors, will be able to trade the shares. And remember, all of the pre-IPO investors will be locked up for about 6 months. And Friday will definitely be a very volatile day. And remember, because these IPOs are so big, whether it's SpaceX or OpenAI or Anthropic or even the Google secondary, they're basically sucking up investor demand, institutional investor demand. And what that does is it saps up demand that normally would have been entering the market to buy other things. And so that's why people are often very cautious when you have a big IPO boom, because it saps up a lot of investor capital. And already, retail investors are the most fully invested they've ever been. Cash at mutual funds, I think, is under 3%, at a multi-year low. So the incremental cash, that's going into trading this IPO, right, is going to be taking away from the other major companies in the Nasdaq. I wanted to take a break there and see if you had any questions.
Yeah, a few. So I have a chart showing how big SpaceX is right now relative to all the commercial aircraft and the defense companies, publicly traded sectors combined. This is pretty stark. I'll show that in just a minute. Just on the IPO process itself, when we say, and headlines have been saying this for quite a few days now, that the stock is oversubscribed, or the IPO is oversubscribed at this point. You even brought it up yourself. What does that mean? I think retail traders who want to enter on June 12th want to know who's on the opposite side of the table. Who's already oversubscribed to this?
Yeah, that's a very good point. So, as we went through the three parts of the IPO, through the marketing phase, you get these investors
Hmm.
that effectively subscribe: pensions, endowments, hedge funds, sovereign wealth funds, and effectively qualified institutional investors. Um, what they do is, they subscribe and say, we want X allocation of shares. Okay.
Yeah,
So there are three groups of these types of investors. So there's qualified institutional investors like mutual funds, hedge funds, insurance companies, pension funds. They usually receive the largest allocation of shares. Then you have the non-institutional investors, which are like high net worth investors and corporations, and then retail investors. And what these guys have done at SpaceX is if they've set aside 30% of shares for retail, which is actually quite unique. And so what ends up happening during an oversubscription is, there's share rationing. So, like I said, if they're 555 odd million shares and, the book is 2 times oversubscribed, what it means is that investors have put in for 1.1 billion shares across, these three different groups of investors. And so what happens is when you have a book that is oversubscribed, you have something called share rationing. And that is where the shares are distributed proportionally or through a lottery system, and investors are allocated a minimum lot size, especially the institutionals, to make sure they get at least some shares. But then there is, if demand is incredibly high, like if it's multiple times oversubscribed, underwriters and the issuing company, may increase the offering price right before the IPO.
sure.
Or release additional reserve shares to raise more capital. And both of those actually end up putting more pressure on the IPO post. So let's say on Thursday they've raised the IPO price, instead of 135, they raise it to 160. Well, then the probability of it performing better right off the bat, is lower if they do that. So there's a balance with these banks. They want to price the IPO at a point where it will rally,
Hmm.
um, and it won't sell off right after. And they do that, through these reverse inquiries and speaking with investors. But that's effectively how, that's
But
what effectively this oversubscribe means, what it means.
do these institutional investors receive allocation lower than $135 a share? In other words, to get a discount before the IPO date? Does that usually
Um,
happen?
so they often do. So so there are multiple points of the IPO, right? So
Yeah.
um, there is a fee that underwriters often get for doing an IPO. And that fee is usually, like 5 to 7%. Here, it's going to be much lower because of simply of the size of the IPO, and Elon's done a good job um, pitting all these brokers against one another. But this is called an underwriting fee and a selling concession. Um, and to your question, do large investors get discounts on the SpaceX IPO? That's another um, topic. They don't. So the banks do get a fee, but large investors do not receive discounts on the SpaceX IPO.
Yeah.
Now with SPACs, that's different. With SPACs, you actually do get better treatment and discounted treatment, but with actual IPOs, um, the price set during the book building process is basically the flat offering price for all participants, which was originally set at 135 a share, but could be higher
Mhm.
later.
Okay, so this goes to my earlier comment. How big is the SpaceX IPO? Somebody put this graphic together: 1.75 trillion market cap at IPO, and combined, you've got all the other defense companies. Sorry, not all the other commercial aviation companies, traded publicly traded aviation companies put together, Airbus, Boeing, combined with others, Northrop Grumman, all smaller than SpaceX. This reminds me of Tesla being larger than GM and Ford with only a fraction of revenues. My point is, you've got institutions oversubscribing to the stock before the IPO. Clearly, they don't think it's overvalued, dramatically overvalued. Otherwise, they wouldn't have participated, right? So, all this claim about the valuation being completely insane, well, it's not insane to everybody. I mean,
No, it's not.
yeah, how do you draw this line? Because I think it's important for the public to understand that somebody doesn't think it's insane.
Yeah, but I mean, somebody doesn't think it's exchange. It's insane. I mean, that's true. I mean, global equity markets are around 120 trillion,
Yeah.
right? So if you think about that, this is basically 75 billion. And while it's a very large IPO, it's a very small percentage of the overall market. So there are some hyper growth investors that are willing to bet on Elon, right? And it's not like they're betting on the float is going to be very tiny. So a small number of investors can move this 1.75 trillion company around because there's only going to be 75 billion outstanding. And if we just quickly do, the math, forget about the 120 trillion market. If we just do 75 on 1.75, it's only 4% of the float that's actually going to be trading. So they might think that because the float is so small, that this could break much higher. And just quickly going to our prior point, I think the negotiating fee rate for the banks for this $75 billion IPO is like 75 basis points, which is basically 0.75%. So if we just run that through, they're only going to make like 562 million on this IPO, which is fairly small because usually the percentage cut is much higher, like as I mentioned, 4 to 7%. And then quickly on, not to confuse investors, when you talked about the discount, and I mentioned only SPAC investors get a discount. Everyone gets a flat offering price for IPOs. The discount that people might be thinking about is that investors that participated in prior rounds, like the Series N round at 270, at 270 prior to the 5-to-1 split, that was at a much lower valuation, pre-split than the current stock price. So investors that got into prior rounds, right, they basically hold the stock at a discount and then they monetize that after 6 months. So hopefully that clarifies things.
Overall, then, would you be participating in this IPO? Yes or no, and why?
So I actually already have exposure to this IPO through, a holding company.
Hmm.
Called EchoStar, where my cost basis is kind of in the 80s,
Yeah.
and effectively EchoStar was a company that owned a lot of spectrum, where it basically sold spectrum to SpaceX in return for cash and stock, and so it created SpaceX. Back when it was valued, around 400 billion initially, and so effectively, I think that at 1.75 trillion, that stock is worth over $160 a share versus where it's trading at 116. And obviously there's some discounts because of timing, and people I think are using it to hedge the IPO by shorting it. But I already have exposure. I've actually already made money on the
Hmm.
SpaceX IPO if I were to lock that in today. But
Awesome.
if the IPO were to launch and the stock were to rally, obviously I think Sats would also follow suit, maybe at a slightly lower beta. Um, I think it's I think there's a chance that this IPO could trade marginally higher than when it's priced, but because this has been such a well televised IPO for months and months and months, and it's such a big company at 1.75 trillion, without any cash flows, and without any imminent positive catalysts in the very immediate term. I think it very well could break higher. I'm just not. It, I'm just not the type of person that plays IPOs
Sure.
without some clever way of getting in cheaper.
By the way, Google is going to pay SpaceX $920 million a month for compute capacity and XAI data centers. My question isn't about this particular deal. It's about the fact that people have been noticing tech companies have been paying each other with deals such as this for months and months and months. And the narrative that the AI trade is being propped up by tech stocks paying each other, is that sustainable? Is that just normal? Is that just a going concern, shall we say, at this point, meaning we can expect that going forward as a healthy part of the B2B transaction narrative? Or do you think this is a sign that this cannot continue?
So that is a great question. Initially, we participated in this AI boom, right? From starting 3 years ago, because our view was that the Mag 7, which was doing several hundred billion in free cash flow, had the means to get into this AI productivity transition and buy GPUs with their existing cash flow. Unlike the 1999 2000 tech boom, where you had a number of companies that were IPOing with zero revenue, zero cash flows, valued on eyeballs, and there are huge telecom builds, and there's 20 times as much fiber laid as was needed. So even though the internet was ultimately successful, which I assume AI productivity will also eventually be a big part of our economy, a number of the companies that surrounded that ecosystem effectively failed, right? Outside of many of the companies we know today, Amazon, Google, et cetera. In fact, there are companies that it took many, many years for them to hit their prior NASDAQ highs, like Cisco and Oracle, et cetera. But what we see today is that capex, AI capex is over 700 billion this year. It's expected to go to 900 billion next year. We've gotten to a point where almost all the free cash flow and more of these companies like Meta, Google, are being spent on GPUs, data centers, memory chips, and investors are worried about circular deals being
Yeah,
set up with SPVs, where Nvidia will invest in a supplier. Just the other day, it was very funny that Marvell, where effectively Jensen invested 2 billion of from Nvidia's balance sheet. He went on live TV and said Marvell is going to be $1 trillion company, and the stock was up like 25%. And after that, on the Friday sell-off, we've had another big sell-off. Today is Tuesday the 9th. We had another big AI sell-off. The stocks was down 4.5%
that's right.
intraday. Um, but people are worried that you know Jensen, who's been incredibly successful with Nvidia, and several other people that benefit from AI, consistently go and pump the market. Whether it's Masayoshi Son SoftBank, right, who I think is overpaying for OpenAI shares and continuously pounds the table on demand. Whether it's Jensen, whether it's CEOs of Micron. I think the most conservative people in this ecosystem are effectively the Taiwanese, like the TSMCs of the world, and the Korean chip makers, and ASML, the Dutch the lithography company manufacturer, and they're the ones constraining capacity in the market. They're keeping Jensen from like doubling his GPU capacity every year and flooding the market with Vera Rubin chips. They're the ones that are prolonging this AI cycle and preventing a bubble from bursting very soon. They've extended the cycle, I think, by a couple years. But there's a very popular graphic that was published by Bloomberg, and then Michael Burry's also published a number of these where OpenAI is investing in Oracle, and Oracle is funding OpenAI's data centers, and AMD um, is part of this circular funding as well. And you have Micron and Nebius and CoreWeave, which effectively is just a conduit that buys NVIDIA GPUs and builds its own data centers. They're names like Figure AI, which are private, where you don't even know what the financials are. And Microsoft and Honey AI. So this inflated demand that is
Yeah.
created by companies just taking all their cash flow and investing in each other, or round tripping, I think is concerning. What it does is it allows this AI development to accelerate at a very breakneck speed, but that speed also creates supply bottlenecks, and it results in these guys overpaying, right? So you look at something like Micron, where the cost for memory has gone up like 10x over the last couple years, right? Just go to your Best Buy and try to buy a RAM, even for your
Hmm.
PC. It's incredibly expensive. Look at SanDisk, for example, as well. So what's happening is they've accelerated the spend. For example, NVIDIA is investing billions into companies like OpenAI or other neocloud providers, and then they're using that money to basically buy NVIDIA GPUs. And so what this does, it creates, eventually, it won't happen immediately, but it creates a potential for a cascading collapse risk where, you know, it'll be the companies that are very early on in the supply chain, like the optoelectronics companies, the memory companies that will sell off first. And then further the deeper you go into the supply chain, then the GPU guys like Nvidia will sell off, and then you'll have the last people to sell, the last companies to sell off will be the power providers, because you need steady
Yeah.
power demand for these data centers. But this whole supply chain, I think, is just betting. It's just one trade, right? All these companies, the hundreds of AI companies in Japan, and link companies in Korea and Taiwan, all of these companies, the hundreds of ISINs and QSIPs that across debt and equity that have rallied, you know, there could be a big unwind. And the easiest way you could see that unwind is if tomorrow Meta says, "Oh, well, the EU is not letting us develop, AI in Europe, or AI ROI isn't happening." In fact, 70% of data centers that were supposed to strike ground in 2027 haven't even been
Sure.
started. So at some point next year, you could have Microsoft, Meta, or one of the neo cloud guys say, "Hey, these data centers are taking a long time, or we can't expand in markets where we want to expand, and we're going to need to cut back." Because right now, and what NVIDIA is doing is, because you need, like, you in the beginning, they thought you needed 7 million worth of memory for every Vera Rubin GPU rack, that they were basically over ordering and locking up inventory. The same thing happened during COVID, where companies were worried about the supply chain and they basically over ordered like 3 or 4 times. And what it
Hmm.
did was it created inflation. We're seeing AI hardware inflation. And then, a year or two later, the prices came down. And, memory, semiconductors are historically very, very cyclical, and the prices can go up very dramatically, and they usually fall a year before the demand falls, because people look at the supply chain, they start predicting when these companies are going to underperform. So I'm not saying that this is going to unravel immediately, but this is a hardware sector, um, and this is not contracted revenue. You will see a point in time, very, very soon. I mean, within the next 2 years, where there will be a number of hiccups where the market could be down 10, 15% overall, because semiconductors are now like 20% of the broad indices. Megatech is like 40% of the index. If In fact, if you take tech out of the S&P 500, right, it's really barely moved on the year. So you have a hyper
Hmm.
concentration
Hmm.
in basically one trade. SpaceX is now basically an AI company, right, as well. So I am a little bit concerned, that, with hyperscaler capex across Amazon, Google, Meta, Microsoft, and Oracle, now expected to be, over $1 trillion by 2028. If that number were to come down, or cloud revenue were to come down, because the cloud backlog is one of the things that's driven this capex higher, or if cloud revenue growth estimates come down, which is a precursor to capex coming down, there could be an unwind of this trade.
By the way, there's now a trade on Kalshire prediction market. When will Tesla and SpaceX merge? Before May 2027 is when this trade closes. 56%, so greater than 50%. Is that the play? Is that why the valuation's so high? What do you think?
Um, that's a good question. I think a number of people have suggested this. I mean, Elon has a history of merging companies into his companies, that are related parties. You saw this with the Solar City IPO, for example, which was his cousin's company.
Well,
Um,
sorry, just before we continue, you've worked at one of the top shops for M&A in history. What is the banker's philosophy or checklist for evaluating whether two companies would synergize in a merger? And maybe let's see if these checklists apply to SpaceX and Tesla here.
well, usually when companies merge, you have to identify revenue and cost synergies. And I will say
Mm-hmm.
most of the time revenue synergies don't pan out. We call them bullshit, cross-selling, et cetera, et cetera. There is a little bit that plays through, but usually it doesn't work. And usually the main synergies are cost synergies, right? If you have two companies with similar end markets, you can cut SG&A. You can cut you can through a group, a larger scale, you can reduce your purchasing costs, from vendors. So there's several ways that you can actually extract synergies from the business and improve free cash flow per share. So right now, prediction markets are currently estimating like a 50 to 60% chance of a merger between SpaceX and Tesla by mid 2027. But if you actually think about the
Mm-hmm.
synergies outside of maybe like the AI data center, I really don't see the synergies outside of just concentrating Elon's time into one entity, but it will
Yeah.
still be a lot of different separate businesses within that business. So I think one benefit of a merger might be that SpaceX, it's easier for SpaceX to raise capital than some of Elon's smaller ventures like XAI, and so he's able to use a bigger company to raise capital for smaller companies. But it will also face some roadblocks and risks. A combination of that magnitude would face antitrust and regulatory hurdles because all these companies have so many government contracts
Yeah.
that it would, likely have a regulatory approval. But in this, I don't really see a lot of actual cost synergies. So, and Elon, when he merged Solar City into Tesla, there weren't a ton of synergies either, but he did it anyway. So anything is possible.
That leads to the last part of our conversation, special just situations. So another trade, which companies will officially announce an IPO this year? SpaceX has already priced it. Anthropic at 91%, OpenAI at 88%, and then a few other companies and tech, especially in tech as well. Now, first of all, which IPOs are you personally looking forward to the most that have, in your opinion, the most market impact? And second, do they present special situations per your definition? And if not, tell us about some of your own special situations.
Yeah, absolutely. So, we have avoided a lot of the market volatility this year by focusing on trades, that are one more conservative. We have 700 high yield preferreds, many of which yield over 10% and are backed by real estate, are backed by real assets and cash flows, at REITs, insurance companies, master limited partnerships, that own energy pipelines, transporting much needed natural gas and oil across the U.S., telecom companies that still use baby bond and preferred markets. And many of these bonds are actually backed by, they're actually unsecured or secured bonds, and not just perpetual preferreds. And I would say a third of them are floating rate. So if interest rates go up, they actually benefit, whereas two-thirds of them are more fixed rate. So we've been able to create this universe, which is over 1.3 trillion of securities, where you can trade, some of these $200 million issues, buy them at 80 cents, sell them at par, and with the coupon, make 20, 30% trading these preferred. So that is a bread and butter part of the business, and it consists of about, 25 to 30% of our portfolio. Outside of that, we have a margin of safety of cash, given how high valuations are, and money market treasury like securities. And then we do a number of merger arb, so lower beta trades, where we bet on a target that's being acquired, Oftentimes we look for all cash deals where you can buy at a healthy spread and bet on the deal closing. We also look at spin-offs, split-offs. For example, when GE broke up, a number of its ultimate subsidiaries, doubled and tripled. Whether it was in jet engines, turbines, or healthcare, because of the conglomerate discount. So that's an example of a spinoff that has done well. We also do quite a lot when it comes to shorting companies ahead of their 6 month IPO unlocks or SPAC unlocks, where a company is excessively overvalued, and we bet on insiders selling shares and the market cap falling precipitously. So I'll just give you one example of those of that company because it's actually tied to the SpaceX IPO, and it's a company called VCX.
Hmm.
So VCX, was effectively a fund set up by Fundrise, and it was comprised of effectively hundreds of thousands, over 100,000 investors that basically had clamored to get into this fund. And this fund effectively IPO'd in March, um, and it held stakes in some very prominent companies, everything from OpenAI to SpaceX. So there are other funds like this, like DXYZ in the market. There's a new one, PWRL. But the most overvalued one in the market was this VCX. In fact, we had tweeted about it. If you look at our timeline, back in March, it was trading at $565 a share, or roughly 40 times its stated NAV, over 40 times stated NAV of about $20 a share. And we started to get short around, once the options were listed, around 300 a share, at in March a couple different times, and the shares currently sit at about 150, so they're down 50%. And since we were able to use options, our returns were actually much better. For our 3,000 Discord subscribers or whoever had done their own research. Even as early as um, we reshorted this effectively 2 or 3 weeks ago. At that time, it had very liquid, it had relatively liquid options, had a market cap of well over 7 billion against net assets near 650 million. So it was basically trading at 11 times NAV, and we did an adjusted NAV, assuming SpaceX would IPO at 1.75 trillion, Anthropic would IPO at close to a trillion, Databricks and OpenAI would IPO at elevated valuations, and basically we would put together a new NAV of instead of 19 odd dollars a share, at about $30 a share. So it was trading, around 7 times that NAV. So we thought, okay, this is trading at 600% higher than what we think it should trade at. It's relatively interesting to short because there was a 6 month IPO lockup. So we talked about IPO lockups with respect to SpaceX. Because this IPO'd in March, there's an IPO lockup coming in September. So we thought, okay, it's May. There's just 4 months left. Its reported NAV is 1897. Our NAV is 30. So, total, AUM is basically a billion versus it's trading over 7 billion. It has 28 million shares outstanding. It basically has a small float because 80 to 90% of that was locked up. So that's why it traded where it was. And we effectively went through each line item, built some of the parts to get what our valuation was. And, we had a small short, and we have a basket of these shorts at any time that effectively offsets our longs. And that trade was a special situation that worked fairly well. Now on the long side, what we've done is we've started to go into sectors that we think are fairly undervalued. And sectors like REITs and banks and healthcare are very undervalued versus tech. If you look at the last 10 years of historicals. So we've been doing fundamental work on companies like CVS, which has sold off dramatically because of its PBM and an insurer, but it actually trades extremely cheap. Um, if you were to build a sum of the parts today, we've also even played tangentially in the AI space. We actually got long for a very short term trade, a company called T1 Energy, which is was set up to be one of the leading providers um, of energy, for this whole AI space. And we also got long a company that was fairly risky in a small size called DGXX, which is called DigiPower, and they effectively got a very large contract. So we were long, from $3-4 a share, and effectively the company got a very large colocation. AI related contract of over 1.7 billion, and the market wasn't valuing that because they thought it would have to raise some equity. um, so you know there are a lot of ways that stock actually more than doubled in a very short period of time, and we were able to sell part of our position, and also hedge the remaining position with covered calls. So there are a number of ways to play the market, with different levels of risk. With prefs that are very, very low beta that pay you 10%, where you get some capital appreciation, with value stocks, like CVS, and with smaller cap names that have multi-bagger potential, that are linked to AI, but you size them very small. So, your
Sure.
capital at risk is not very low. We also attended, the IRIS-OWN conference very recently. Um, and, there are a number of really, this is my third time going. There are very interesting pitches, from everyone from, Greenlight Capital, um, to, um, to new managers on the value and on the growth side. Now, before we get into the IRIS-OWN names, some other names that we've been long on the merger arb side, were Caesars from a very low price, which just got bid by Fertitta, MGM Resorts, which also just got a 48.30 cash share proposal by what used to be IAC, which is now Peoples. Effectively, if you built a sum of the parts on MGM, you could effectively look at its 50% stake in BetMGM with Entain, which is its premium assets, its Japanese assets, its 50%, 56% stake in MGM China, and then all of its Las Vegas properties. And Asian properties, and you would have got into some of the parts using conservative multiples around $60 a share. So, we had a very low cost basis, and we were fortunate that we got this $48 a share bid, and we think there potentially could be a topping bid. Another name that we were looking at was the FedEx SpinCo, FedEx Freight, FDXW, which actually traded much better than we thought. And that's just a flavor of names that we're looking at. And the biggest
Sure.
spreads in the market right now are WBD Sky, which is going through antitrust right now. You guys are very familiar with Larry Ellison funding this Sky bid for Warner Brothers. It's a 67 billion market cap. They're paying a very large cash bid, and there's a $4 spread there of roughly 15%. So if it passes antitrust, right, that should compress over the next year. Also, NSC UNP is a 12% spread. DNEE is a 6% spread. So we keep track of a lot of these merger spreads as well.
Excellent, Jay. I really appreciate that. That's plenty of special situations for us to think about. And we'll follow up after the SpaceX IPO. I think there's going to be more IPOs in the summer to discuss. Thank you very much. Where can we learn more about your special situations in the meantime?
Absolutely. So if you would like to learn more about special sits research, and for example, the over 50 pitches that we collected from
Wow.
IRIS-OWN, including value pitches, growth pitches, and shorts, which we're happy to share on our Discord and through email. You can go to specialsitsresearch.com. You can join our Discord, which is a premium Discord. You'd have to sign up for it using either our Twitter handle or the website. And follow us on Twitter at specialsitsnews.com, where we publish hundreds of free educational tweets about macro, oil, interest rates. We have CPI and PPI this week, by the way, where we publish on special situations, where we publish on geopolitics, where we publish on income names for free. And we have one of the largest institutional, professional, and retail investor communities where everyone shares ideas in our educational Discord of over 3,000 people. And our focus is really education, and we give the same ideas to the $50 billion hedge funds that subscribe to us as we do retail. We just provide those ideas in different formats, including our Sunday podcast, which is a 2-hour long podcast before futures open every Sunday, or through long form memos and alerts through our platform. So I do appreciate you giving us a follow at specialistnews.com. We do have dozens of ideas every month that we talk about with different levels of conviction. We raise them with a risk ranking score from 1 through 5, so that you can judge for your own and do your own work. But again, I want to thank you for your time. And on the next call, we definitely have to talk about how 46 out of 68 global central banks are overshooting their inflation targets, and how the ECB stated that that gold is a bigger reserve asset now than the U.S. dollar. And I'd love to come back and talk to you about upcoming IPOs and macro as well.
Yeah, we can definitely discuss that. That's interesting that you think that they believe that they're overstating inflation expectations. Thank you so much, Jay Singh. We'll talk soon, and do follow Jay in the comments down below, and do follow Special Situations. I'll put the link in the description where we can visit his work. Thank you so much, Jay. See you next time.
See you next time.
And thanks for watching. Don't forget to like and subscribe, and don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Traders who use my code can get $10 when you trade $10. Link down below in the description, or scan the QR code here.